My guest on this ET interview today is someone I've interacted with for nearly 20 years. He needs no introduction whatsoever. And what I've admired and always appreciated about him is his faith in India. He's always been a big India bull and always maintained overweight stance in his model portfolio for Indian equities. Chris Wood joins us now, and he joins us in a new avatar. Chris Wood's, not CLSA, but Chris Wood Jefferies. Chris, fantastic to meet you in person in Mumbai. Welcome to India.
Hello, good to be back.
Are things shaking up for India? You have been a long-term India bull, but given where the economy is, where the macros are moving, where the investment and the capex cycle is moving, is the long-term bull of India someone like you? Are you having double thoughts? Are you having second thoughts?
No, but not really, no. But what I would have to say is the collapse in growth this year in India has been dramatic. I was last in India 7 months ago, and clearly the collapse of growth since has been a surprise to everybody, be it the government or the private sector. And that collapse is best reflected in less in real GDP, but in decline in nominal GDP growth and in the decline in private sector activity. So clearly it raises the issue why this collapse in growth has happened. And I think the most plausible explanation is that it's basically the body in a bit of sticker shock as a response to all these very dramatic structural reforms implemented by the Modi administration since 2014, combined with some complicating factors. So we're basically moving from one way of doing business to another in India, and clearly when you ask what reforms, the bankruptcy court's one big issue. Clearly we had the combination of Deman and GST. Then we had not a reform, but the NBFC liquidity squeeze, which still continues. We have the RERA in the real estate world. But I also believe there's another issue right now, which is to do with late payments in the system, because the collapse in growth, also the collapse in tax revenues is equally dramatic, clearly is blowing out the fiscal. And because the government's accounting system is cash-based, that apparently has led to payments slowing throughout the system. So this has probably created a ripple effect from the central government through to states, through to corporates, through to small SMEs. So I think that's a factor too. The last quarter's data, so third quarter calendar year data, we did see a big pickup in government spending. So maybe that's seeking to make up for that. But the bottom line is there is an issue right now which the market's focusing on, because most people in the market believe the fiscal deficit is running nearly 5%. The government, I believe, is still committed to this official 3.3% target. If that's the case, the signal in the system will be to delay payments. My own personal opinion is that the stock market and indeed the bond market would be relieved if the government just said this is a way bigger growth slowdown than we envisage, and the fiscal deficit is going to be much higher this year. I don't believe the markets would sell off dramatically on that, because the market's already assuming that. But I'm not sure that market psychology is understood in Delhi.
So let's pick up all the aspects which you have just pointed out one by one. First, what is your understanding of the growth cycle? Are we in a long winter, or do you think this is the light at the end of the tunnel, and the recovery from here is going to be very sharp and smart?
No, but we're in a bit of a game changer. The modus operandi in this economy is changing. You can now lose your assets in the bankruptcy court. So this SR Steel case appears to be a game changer. My understanding that the bankruptcy court, that personal guarantees are never going to become real in India. So all this actually is going to lead to risk aversion on the part of many traditional businessmen, assuming their assets aren't already in the bankruptcy court. If an asset's in the bankruptcy court, it can't really be invested in, so it's frozen. So this is going to take time. So then there's another issue. There's all these apparently all these so-called stuck residential property projects. I can't remember the number, but there's a lot of them. A lot of them are the higher end property. The quickest way to resolve the stuck residential property projects would just be to set up a big auction process and sell them. That would happen. Then you would have a V-shaped bottom. The problem is, in the first instance, that will cause a further write-down in collateral values of the lenders. So people are reluctant to do that, and there's an additional complication that the creditors don't just include banks, it includes people who have put down 50% individuals. So this is going to be a complicated matter to resolve, and if the government seems to have set up a fund, but you know that's going to take time. I think it's a public centre. You basically need the private sector trying to clear up this situation. So yeah, I haven't got, I think we're near the end of the tunnel, but I think it's going to take time. But the near-term issue is this fiscal situation.
So you would say that if India this year and even next year, if they compromise on their fiscal deficit target and if they bust their fiscal also, that's not going to disturb rating agencies and strategists like you?
Well, no, frankly, I don't know about the rating agencies. I don't think they're as relevant as they seem to think. I think people in Delhi have too much deference for rating agencies. I personally don't think the rating agencies are that important. But from a market psychology standpoint, I think the market's already assuming the fiscal deficit is 5%. So if that's the case, you just want to admit it. Now, obviously you can try and rush sell PSU stakes. Personally, I think it's great that they've made a strategic, there seems to be a decision made to sell these PSUs down for strategic reasons. But you should do that for strategic reasons. You shouldn't sell PSUs on a short-term basis to fill a hole in current spending in the budget. One other unfortunate thing is this corporate tax cut. The corporate tax cut's extremely positive. But if you understood market psychology, you would realize that there's no need to cut the corporate taxes for this year. If the message had been sent loud and clear that the corporate tax cut was going to happen in next fiscal year, that would have had as positive an impact on the market as what was announced a few months ago, but you wouldn't have the problem of filling in the hole this year.
The old-timers like yours who've tracked Indian markets and Indian economy for 20, 30 years, they are telling me that this is one of the ugliest patch they've seen. Only exception was 1991 when...
No, I would agree with that. But my point is, my point is that the slowdown here, in my view, is in large part due to the shock effect of these structural reforms. So demonetization clearly hit the SMEs traders. Then we've got GST. So I think that combination is a big shock. But I think they're long-term positives. Then in the real estate market, the Real Estate Regulation Act, combined with demonetization, because the black money was in the real estate, is again a massive shock. It means that there's the most massive consolidation in the property developer situation. Then we had something which wasn't to do with reform, the NBFC funding crisis, which basically means all those loans the big loan growth from 2015 to 2018 came from the NBFCs, so they're disappearing. Now, we've had one major failure so far in the NBFC space. Clearly, people are worried there may be another. There's a lot of talk about there should be an Indian TARP. However, this government, I think for commendable reasons, is very wary of the moral hazard issues.
From a policy standpoint, both on the fiscal front, monetary front, also in terms of messaging to the corporates, do you think the messaging from the current administration is right?
In what sense?
Messaging about, look, we don't want to bend the rules. We will not go out of the way to make exceptions.
No, I think that is right in principle. The point is, in the Western world, they've got used to bailing out everybody and anybody, particularly in the financial world, at the first sign of trouble. This administration is not taking that approach so far. So to me, that's to be commended. But it will create more short-term pressure. No, and similarly, if you're a businessman and you believe you can never lose your assets, and your personal your personal guarantee will never be called, you're going to have a very different attitude to borrowing, if you believe that you can lose your assets and your guarantee will be called. So this actually is a game changer in the Indian economy.
If I look at markets, Indian markets, at least benchmark indices, they're at an all-time high. The economic print is at a decade low. Why is there such a big disconnect between what stock markets are doing versus the underlying real economy?
Well, one very important point is the mid-cap and small-cap indices are well below their all-time high. So that's the area of the stock market which is showing you the economic pain. So if you believe the economy is recovering, that's what you buy.
Do you think the economy is recovering, and how soon will it
No, I've got
recover?
no confidence the economy is recovering this quarter. All the evidence is the economy is still weak. I think if you're being conservative, my basic view is you should hope the economy is picking up in 4 quarters and be pleasantly surprised if it happens earlier.
So are you making a case that for stock market investors, we are not in for strong double-digit gains for next 12 to 18 months?
Oh, no, because the economy recovers in 4 quarters, the small mid-caps will move before then. But again, to your point on the index, I completely agree. It's remarkable how well the benchmark blue chip index has behaved. And I have some stocks in my Asian portfolio in India, and luckily my stocks are those which have been holding up. But obviously part of this is just ETF flows into emerging markets. But it's also a fact that the best companies have just not been hit as much, and in the big picture, they're going to benefit from consolidation.
So you've always been a long-term advocate of Indian stocks. You've had double overweight and triple overweight. Currently, also in your model portfolio, you have an overweight stance on India. Are you looking at changing that, or you think?
No, I'm just double overweight India right now. But a key issue we've got to watch is this point on the fiscal. But one thing globally which will affect India and all other emerging markets right now is whether we get a US-China trade deal. And if we get a US-China trade deal, and if the dollar is seen to have peaked, then we will get more flows into emerging markets. This quarter, we've got foreign net flows into India. Now, it's not clear why foreigners are buying India. I think probably a lot of that buying is mechanistic ETF flows into emerging markets, some of which goes into India.
So do you think that ETF flows could be here for another 12 to 18 months?
No, purely that will depend on whether we get a trade deal, in which case it could be. If we don't, there won't be, and whether the dollar peaks. Because if we get a trade deal, which is a big if, I think the trade deal could include a currency component where where China agrees not to engage in competitive devaluation against the US, and that would allow Donald Trump to declare victory. Because the interesting on the currency, neither the Chinese nor the US want a big devaluation of the renminbi against the US dollar.
Now, 10 years ago, you called 2 large trends. First, you said Indian private banks have a long way to go. So you, in your model portfolio, included Indian private banks and HFCs. And they still are their part of your portfolio. 10 years ago, there was curiosity around them, but now some of the Indian private banks and HFCs are overowned. You still feel that these stocks can, for a stock market investor, give double-digit returns for the next 5, 6, 7 years?
Yeah, but the private banks, I think, about 70% of deposits. So, sorry, the public sector banks are still, so that means there's still a big growth opportunity for the private banks. But right now, my portfolio is more inclined to corporate banks with more of a corporate lending bias than pure consumer banks.
Why is that?
Because I think the provisioning cycle for the loans to the infrastructure energy space, i.e. the loan problem Prime Minister Modi inherited in 2014 has now been largely provided for.
But if you are bearish on, or if your view is not that constructive on economy, do you think corporate banks may not give good returns? Because corporate banks do well when the economy is on a boom and when credit cycle is moving higher.
Yeah, but the first instance is the problems have cleared up, or are being cleared up, and there's, as we saw in the reaction to the SR Steel case, that's positive for banks. But I also have life insurance in my portfolio, And I think one should consider even mutual fund companies in the portfolio. I wouldn't have it all in private sector banks.
So can insurance do in next 10 years what private banks have done in last 10 years for investors?
Potentially, definitely. And the same potential with the mutual fund companies.
Even though real estate sector in India is in a downturn, you have Godrej Properties in your model portfolio, and you've been bullish on Indian real estate stocks for a while now.
No, I'm bullish. No, I'm not. I'm just bullish on the stocks which have got have the good balance sheets.
Okay.
Because the point is, it's a consolidation story. If 90% of developers are going bust, that's very positive for the 10% remaining ones.
How come there are not too many consumer names, or how come there are not too many?
No, that is the consumer names which I view as really highly valued. To me, that is where the very high value. People say there's really high valuations in India, and I think that's the area.
Do you think this trend where very few stocks or a lot of money will be chasing very few stocks is here to stay?
Yeah, until there's evidence of a cyclical pickup, that will be the story. But any evidence of cyclical pickup, then the money will go in the small mid-cap area.
In next couple of days, not only we will roll into a new year, we'll also roll into a new decade. So I'll first talk about the coming year, which is 2020, and then the decade. My question for 2020 is that what to your mind are the biggest moving parts for 2020? Is it Fed, is it US election, or is it central bank policy action?
No, I think the first key issue is this US-China trade thing. Either a deal is done, or Mr. Trump raises the tariffs as threatened. If he raises these tariffs as threatened, I think it's extremely negative. But my base case is he won't raise the tariffs and he'll do a deal, but we just have to wait and see. So I think that's a key issue. Then on the monetary policy, the key development actually happened in the first quarter of this year, which was the Powell pivot. The Fed went from being hawkish to extremely dovish. So that's now happened, but I would say a key thing to understand right now is although the Fed has put rates on hold, it's now resumed balance sheet expansion. Now, it's not calling the balance sheet expansion QE, but the markets are viewing it as QE in all but name, and that is helping propel this current risk-on environment. Clearly, the other big thing will be the US presidential election. In my view, there's no point really thinking about that until you know who the candidate on the other side is.
Post the trade war which rolled out in March 2018, China has underperformed, India has done okay, and US markets have touched a record high.
China's outperformed this year.
On a relative basis, I'm just looking at from the trade war when it got rolled out. When a part of Donald Trump's problem is he's done what you've done, linked the trade war with the Chinese stock market, but that is a big misunderstanding. So Donald Trump has overestimated his leverage with the Chinese because the Chinese stock market had a significant decline in 2018, but it had almost nothing to do with the trade war. Trump thought the market was declining because of his trade war, therefore he thought he had leverage. He was wrong. The market was declining because of a self-induced squeeze of the shadow banking sector by the Chinese government. Okay. Now let's talk about asset allocation for 2020. Would you lean towards emerging markets or developed markets more?
No, my view is purely contingent on what happens on this trade deal. So I've got no view on 2020 until after this tariff deadline happens. There's no point having a view until then. The most important thing short term is what happens on this trade deal.
Looking at the longevity of the US economic cycle, I've been told that this is the longest US economic cycle after Second World War. Are there chances that there is going to be a leverage crisis there? Because some of the global commentators are saying that the US private debt has moved to public debt. If interest rates go higher, it's going to be a problem for them to serve it. Do you think we should pay consideration to the fact that US economy is now reaching what could be called as a climatic top?
Yeah, the problem with that argument is while it's a very long cycle, the growth rate hasn't been rapid. The trend growth has been 2%. We're now at 2%. So because the growth rate hasn't been rapid, it's less clear why this cycle should die naturally of old age. If the Fed was still tightening, I think that would be a real risk. But to me, that risk has diminished precisely because the Fed has done a U-turn. This time last year, the US economy looked more vulnerable because the Fed was tightening, the credit spreads were rising. But if my base case on the trade deal is wrong, and he doesn't roll back any of these tariff increases, but that he raises them on these consumer goods, then I think the risk rises that definitely the risk rises that the US slows below the current 2%, because all the US growth is it's all in the consumption area. There's no, the capex is not picking up.
Just to wrap it up with a couple of closing comments. You've been long. You've been advocating on your newsletters and various forums that one should buy into gold. Somehow the long gold trade has not really worked out as beautiful as what all of us thought 5-7 years ago. Will the next decade belong to gold?
Well, that really depends what happens to real interest rates in the US. So since 2002, gold has done well, but since 2011, it clearly had a cyclical bear market. My base case is gold's in a new bull market. The real rates came down in the US this year. That's why gold rallied, but gold right now is at a key technical level of 1460. But in my view, the direction of travel is on central bank policy is for more monetary easing. And on a 10-year view, I think it's entirely possible we have G7 central banks engaged in policies which are being called modern monetary theory, which basically is central banks financing government spending directly, not indirectly, directly. And if such policies are introduced, which as I say is the direction of travel, not in India but in the G7 world, then that long run should be very bearish for bonds and bullish for gold.
So then why are Indian bond yields at 6%? I know countries which have a much poor fiscal health. They almost have a bloated balance sheet, almost debt levels unmanageable to serve. The cost of borrowing in those countries is much lower than what India has.
Yes, it's a very good question. It's completely unfair. So I would say, given this government's been fiscally quite tight, I mean, the rhetoric is tight. Let's say they really stick to this 3.3. Then actually, the long end of the government bond market's a buy here. But we have credit growth going down in India.
But if you have to, let's say, do a messaging for the market and for our viewers and for somebody from the government really watching the show, your message would be, don't worry about the fiscal deficit. Markets know that it would be busted, and there is no harm in admitting.
But it's very important how that is communicated. So if it's communicated the right way, the message will be taken positively.
And
because the point to understand is the market's already assuming the fiscal deficit's at 5%. Now, the government, Delhi, is quite understandably concerned that if they run a 5% fiscal deficit target this year, then it will create, and they'll never get it, which I fully understand. But this collapse in nominal GDP growth is truly dramatic. And as I say, I think it's basically a combination. If I had to single out one explanation, it's a combination of these structural reforms. But as I say, also the corporate tax cut, you would have had just as positive impact on the market if you had announced the corporate tax cut for next fiscal year. You didn't need to do it. So that shows you a lack of understanding of market psychology. That's all I'm saying.
Okay. Last question, I promise this will be the last one. You understand trends and cycle much more than anyone else I've interacted with. 1970s and 80s, they in a sense belonged to Japan, then came US tech stocks. Last decade was governed and ruled by markets like India and China. Last 10 years, US has got it completely right. Next 10 years, which asset, which business, which country, which region do they belong to?
When you say, what you're talking about in the financial markets?
Financial markets.
Well, no, the big trend you see in the US, the big trend in the last 10 years was that QE led to these asset price rises, suppressed rates, and that in a US context has driven this whole boom in passive investment, indexing, and that has driven the boom in ETFs. And the market has also been propelled by these share buybacks, where US corporates buy back their stocks, and boost the EPS, but they're buying back with leverage. So while it's worked, I wouldn't say it's healthy, because the quality of earnings in the US is actually nothing like, is actually very questionable. because I can show you a chart showing the macro trend of the macro measure of US corporate profits, which is flat, and the S&P profits going up. So, but one trend in money management, which is definitely gaining momentum right now, though again it's not in India, is this ESG.
That's a great point.
So we're getting more and more assets going into so-called ESG funds on these environmental concerns. But for the fund management industry in the Western world, they can charge higher margins on these ESG funds than on regular funds, and they're being attacked by ETFs. So that's why this ESG is gaining momentum here.
I really appreciate your time. So nice to talk to you, and enjoy your stay in India.
Thank you.